All right, so welcome to chapter 6, which focuses specifically on inventory. Okay. Learning objective 1, you've already seen everything from chapter 5, so this is going to be a relatively quick review. The work that's really part of chapter 6 that's going to spend most of your time on is going to be objective 2, which talks to you about what's called the inventory cost flow methods. That's going to be the bulk of the work in this chapter. And learning objective 3 of this chapter basically looks at the how inventory is presented on the balance sheet. And then we're going to look at some financial analysis, a couple of quick ratios that are commonly looked at. Okay. So again, this is a review. Learning objective 1, again, you've learned all of it in chapter 5. Again, the most important thing to understand is inventory or merchandise inventory is an asset to a company. Merchandising is different than manufacturing because manufacturing actually has lots of different types of inventories. And you're going to be learning about this in managerial accounting. No need to worry about it right here, but this is what managerial accounting is going to be focused on at the beginning. We already know the inventory systems, right? There's a perpetual system, which is most common. It's a continual updating of the inventory record. It is usually a computerized system, and it's scanning everything in, scanning everything out. So it keeps relatively up-to-date and accurate records. But even with a computer system, you have to check if it's right. And so you have to do what's called a physical inventory, which is really the hallmark of a periodic system. You literally have to count, physically count the inventory. And then you compare it to what the computer system says you're supposed to have and work out those differences. What the periodic system will tell you is two things. One, what's your inventory left? This inventory is your asset, okay? And if what is not there, we assume has been sold. And so the value of the inventory that's no longer in the store becomes the cost of goods sold. And you saw that happening in chapter 5. Okay, so again, this is about taking a physical inventory. Usually when business is slow or it's closed, they literally take it by hand, physically count the inventory. We already talked about ownership, right? When does the legal title to the inventory change from the seller to the buyer, okay? And that's determined by what's on the sale. So as you remember from chapter 5, it's either going to be FOB shipping point, which means the transfer of ownership of the goods happens as soon as the seller boxes it up and puts it on to the freight company. Or FOB destination, in which case the ownership doesn't happen until the goods reach the buyer's destination, where the buyer physically is located. And again, this is something that was covered in depth in chapter 5, so no big deal here. What hasn't been talked about yet is something called consigned goods. So consignment basically, a company will have inventory that's not not their own. They don't own it, but they're selling it on behalf of some third party. Okay, and they take a fee for that. So consigned goods are not owned by the company that the goods are in the store. So for example, you walk into a supermarket. I think everyone's been to the supermarket at least once. So there are spaces in the supermarket that are consigned goods. So when you walk down the snack aisle for chips and stuff like that, all of those bags of chips that are there are usually put there by the company that owns them. So Frito-Lay, or one of the other, Cape Cod, or one of the other chip makers. And they're the ones that actually, they're delivering the chips, putting them on the shelves and so forth, because they own those chips. They are simply just paying the supermarket to rent that space to sell their chips. Same thing in the soda aisle as well. In the soda aisle, oftentimes there will be, a Coke representative putting all the Coke products there, and a Pepsi representative. So those items are not owned by the supermarket. They would not be part of its inventory. However, they do get a fee for those consigned goods when they are sold. They do get a percentage of the sale as a fee for letting that company use the shelf space. Okay. Certainly, that's true with antique dealers. An antique dealer is, if you've ever been in an antiques dealer, there's many different little spots that are basically consignment. Those antiques are owned by a third party, but they're on display in that person's store, and they get a percentage or a fee for selling those types of things on the owner's behalf. So again, it's not ownership when it's consigned. And that's the end of do it number one. Again, everything you know all about already. Rules of ownership. Here it says, has been company completed its inventory count. It arrived at a value of inventory of $200,000. You've been giving the information listed below, and you are to discuss how the information affects the reported cost of inventory. So here they've included inventory held on consignment. Well, that's a problem, right? Because they don't own that. So it shouldn't be part of their inventory, nor should it be part of their cost of goods sold, because consigned goods are not owned. So they're not part of your assets, and they're certainly not going to be part of your expense as cost of goods sold. So that's a problem there. Here, this company did not include purchased goods for $10,000, which they were in transit, FOB shipping point. So FOB shipping point meant as soon as they were shipped, they own it. And here, the company did not include that. So that's a problem, because they own this inventory. This inventory should be, this $10,000 of inventory should be included in has-been's value. Okay. And the third issue here is the company did not include inventory that had been sold, okay, of 12,000, which was in transit, FOB shipping. So FOB shipping means that the ownership of those goods transferred at shipping. So since they're already in transit, they've already been shipped, in which case this $12,000 cost should be included in has-been's records, because they have already sold that and they've already incurred the cost of goods sold at the shipping point. And that is learning objective 1.